Today, seeking property smoke signals. Hello again, it's Martin North from Digital Finance Analytics. Well, that is posts covering finance and property news with a distinctively Australian flavour. Well, real estate sales are facing headwinds as buyers and sellers grow more wary ahead of the federal election campaign and deal with affordability problems and the prospect of rising interest rates. And of course, there's Easter and the school holidays now, and the upcoming election campaign, which was formally kicked off yesterday after the Fay campaign in recent weeks. Last week, RBA Governor Philip Lowe said the central bank was no longer prepared to be patient with its monetary policy, and economists believe the RBA will hike the cash rate from 0.1% to 0.25% in June, and there'll be more later, as I discussed recently. The Reserve Bank is warning that highly indebted borrowers could face a shock to their finances if interest rates rise by an expected 2 percentage points over the next 2 years. And the central bank also warned that such a hike could cause a 15% drop in home values, which again, as I described over the weekend, is probably understating the downside risk. Estimates using a model of the housing market that takes into account historical relationships between interest rates and both demand and supply factors suggest that a 200 basis point increase in interest rates from current levels would lower real housing prices by around 15% over a 2-year period relative to the baseline model projection in the absence of an interest rate shock, the review said. The semi-annual Financial Stability Review, which was published last Friday, they said that some families will struggle to meet loan repayments if household income growth doesn't pick up to counter inflation. And in the report, the central bank warned of the potential of drops in housing prices lower after inflation incomes, or both, as tighter monetary policy begins to take effect. A quarter of all new home loans have a debt-to-income ratio above 6. The regulator sees as risky. The RBA said the share of high DTI new home loans was noticeably higher than a year earlier. Now, writing before the last weekend, Neela Sweeney in the AFR said that more than 5,000 homes were set to go under the hammer over last weekend, the highest volume so far this year, as vendors rush to sell before interest rate rises trigger a sustained fall in house prices, according to data from SQM. Vendors are racing to sell to make the most of the current strong prices and before the market softened further, SQM Research Managing Director Louis Christopher said. Sellers now understand that this is probably as good as it's going to get when it comes to selling. With the federal election and rate hikes looming, buyers are likely to stay on the sidelines. The shift in buyer demand had spurred many vendors to sell now rather than risk trading into a falling market, said Rain & Horn selling agent Tom Fernan. Vendors want to sell at the top of the market and before prices cool, so there's certainly a sense of urgency for some, he said. I think it's a good time to sell now because I think once interest rates start to rise, the market will soften. It's kind of our last chance to get into a growth market. The upcoming back-to-back long weekends has condensed auction activity to provide bumper choices for buyers, said Nicola Powell, Domain's Chief of Research and Economics. I think the higher auction volume is going to dilute that buyer demand because there's simply a lot more choice. So we're likely to see clearance rates soften across most capitals as buying conditions improve, she said. Eliza Owen, CoreLogic's head of research, said while there was still plenty of active buyers, their numbers had dwindled from a year ago. I think between falling clearance rates, sales volumes, price indicators and days on market, we're starting to see all this evidence that demand isn't keeping the pace it was late last year, she said. It's a little different for smaller markets and regional markets, with momentum slowing only marginally across the ACT and Adelaide. But in the big cities, things seem to be slowing. And news.com.au reported back on the 7th of March that housing prices in some Sydney suburbs had dropped by a whopping 190,000 in the last 3 months, as more experts warn that Australia's property prices are set to plunge. The inner city suburb of Beaconsfield suffered the biggest slump across the country, with house prices plunging 9.2%, meaning that they're now worth $162,000 less than 3 months ago, according to CoreLogic. The popular inner west suburb of Newtown suffered a $120,000 loss in house prices in the past 3 months. That's a massive drop of 6.6% and takes a typical value to $1.82 million. And Surrey Hills faced a loss of $134,000 with prices falling by 6.1% to $2.19 million, while the waterfront suburb of Birchgrove experienced a drop of 6% or $190,000 to $3.17 million. Two Victorian suburbs also felt price pain, with South Yarra prices dropping by 5.2% to $2.16 million and Toorak suffering a 4.7% loss to $4.35 million. The biggest loser in the apartment market was the city suburb of Barangaroo, where prices slumped by 8.5% to $2.29 million, followed by Melbourne's Box Hill, where there was a 5% drop. Eliza Owen at CoreLogic said the premium end of the market was more susceptible to plunging prices, but the huge increase in values had also impacted demand. I think affordability constraints, tighter lending conditions and higher fixed rates have likely been enough to cool premium markets, and the sharpness of the fall relates to the volatility in the high end of the market and the extremely strong run-up in price growth. CoreLogic's index has actually yet to show a significant drop, but as at the 11th of April, momentum in Sydney and Melbourne at an aggregate level is easing. Other capital cities not so much. And of course there is a delay between what is happening on the ground and those indices by at least some few weeks. Anyhow, the AFR's now reported that there were about 1,500 auctions in Sydney at the weekend. The weekend's Super Saturday of nearly 4,000 auctions produced mixed results. Sydney's middle-range market of properties valued up to $4 million slowed. There was weakness in Melbourne's middle ring of suburbs and strong results in Brisbane and Adelaide. The market is entering a hiatus that will keep buyers and sellers on the sidelines, SQM Research Managing Director Louis Christopher said. That is despite neither political party proposing property policies such as an end to negative gearing or the introduction of new property taxes that would generate market concerns or political responses. Andrew Wolfen, chief economist for My Housing Market, a property consultant, said the explosive price rises following the removal of most COVID-19 restrictions were beginning to slow. The cycle is running out of gas as the impact of the pandemic works its way out of the system, Mr. Wilson said. The real heat is coming out of the market. The number of weekend auctions was the most this year as sellers moved to cash in on recent high prices, and that beat the traditional Easter season slowdown and cleared the backlog caused by COVID-19. There are around 15,000 auctions in Sydney and 1,700 in Melbourne. This compares to about 800 and 1,000 for the same weekend last year. Sydney's clearance rate was 65% compared to 81% last year, and Melbourne's dipped to 68% compared to 73% for the same weekend last year. SQM's Mr. Christopher said that the demand for large houses in Melbourne's middle ring suburbs was slowing as the pandemic eases, but Brisbane and Adelaide were still sellers' markets. About 5 bidders competed for a 3-bedroom house in Manor Street in Melbourne's Bayside, Brighton, before a winning bid of about $4.37 million. This compared with mid-range estimates of about $4.59 million. The deceased estate, which is 1 street back from the beach, is expected to be knocked down and replaced with a new house. The market is becoming more stable after the craziness after the end of the pandemic lockdown, Rosalind Mastrangelo, a real estate agent with Marshall White, said. In Sydney, a 2-storey terrace with 5 bedrooms and 3 bathrooms in Edgecliff sold for about $10.2 million, but buyers advocate David Morrell believes uncertainty, ranging from the federal election to rising interest rates, has caused buyers and sellers to hit the pause button. The market is in a state of flux as people look for a smoke signal telling them where the market is going, he said. Others are pulling up stumps before Easter. So sure, the level of uncertainty is definitely rising, and peak price is probably passing, and more quickly than people expect. Again, I'll highlight the fact that the indicators that are coming through in indices are delayed by some weeks. And I also note a number of people also saying that they want to wait and see what happens in the weeks and months ahead with interest rates. So I think the property market is on the turn, but watch those smoke signals because who knows what's going to happen next. Now, if you're buying your home in Sydney's contentious market, You don't need to stand alone. This is the time you need to have Edwin Almeida from Suburban Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Suburban an email at info@suburbanproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.